Good morning, everybody. Welcome to the 2025 Frontiers in Quantitative Finance Conference, hosted by the Wharton School's Jacobs Levy Equity Management Center for Quantitative Financial Research.
Well, welcome everybody to the conference. It's great to be with you today. I'd like to begin by thanking all those who submitted papers for today.
It is wonderful to be here. Thank you all for joining us. Thank you, Craig, and thank you, Chris. It's an honor to be here to kick off this fascinating day. Earlier this month, we announced our first new degree program at the school in 50 years, the Dr. Bruce I. Jacobs Masters of Science in Quantitative Finance. The new program is funded by the incredible generosity of Dr. Jacobs, whose recent $60 million gift to Wharton is the largest single gift in the school's history. Thank you.
Welcome to all of you, my fellow quants. The theme of the conference is Frontiers in Quantitative Finance. While news about generative artificial intelligence appears to dominate the headlines, today's program will demonstrate that exciting breakthroughs can also come from human intelligence, that is using new insights to improve and build upon the innovations of the past.
On the one hand, like in the real world, you want to maximize your portfolio, maximize the Sharpe ratio. Okay, we have many assets to choose from. On the other hand, you don't want to choose too many of them.
The factors that turn out to be most important in the sense that when excluded, they reduce the out-of-sample Sharpe ratio the most, turn out to be this thing called earnings predictability. That actually accounts for like about half of the overall reduction you get if you exclude all the intangibles. The market factor, and then there's this other factor which is a year 6 to 10 return seasonality.
A key element of this paper is that we're not going to be very interested in short-term returns. What we really want to focus on is explaining the level of price-earnings ratios. So rather than explaining fluctuations in firms' prices, we just want to understand why they start off so different from each other, rather than where they're going to move over the next, say, 3 to 6 months.
Sometimes on earnings day, there's like a consensus beat, and then you see the stock prices go down. So it's always curious to me why they beat earnings so well and the stock prices go. Now there's other things like, guidance and all that, but it could be that priced into the actual earnings expectations are expectations that are outside of the consensus analyst forecast.
Incorporating investments in intangibles helps us create a better mousetrap in terms of a factor that has higher returns, negative beta, and also a put-like feature. So I think about those as sort of being incongruous together. And so half of that on the short side seems to be due to biased expectations by security analysts and the market.
Better accounting can lead us to better asset pricing. More precisely, by treating companies' intangible investments in a more sensible way, when we look at the accounting data, that can help us build better models for explaining the cross-section of stock returns. And by the way, for everyone in this room, could also probably lead us to better trading strategies.
The newly established Jacobs Levy Center Research Awards recognize promising research in quantitative finance by faculty members at the Wharton School and the University of Pennsylvania. Wharton and Penn faculty are encouraged to submit research funding proposals that fall within the scope of the Jacobs Levy Center's mission.
I'm pleased to announce that the winner of the 2025 Jacobs Levy Center Research Award is Wharton professor Winston Wei-Dao for his research proposal entitled In Search of Distress Risk with Textual Data and Machine Learning. Winston proposes to build a comprehensive database of forward-looking information from corporate disclosures and analyst forecasts.
Active money management has probably been kind of underappreciated in the economy. Perhaps the way we value it is not quite correct. So I'm going to propose a number of ways to think about this and show that active money management is actually quite valuable.
So what's going on in this model? You've got someone, I'm going to call him an analyst, you can call him a fund manager, but all that's really important is this is someone who's figured out what companies should do.
We now have the pleasure of presenting the 2025 Wharton Jacobs Levy Prize for Quantitative Financial Innovation.
We next turn our attention to the prize-winning work of Sanford Sandy J. Grossman, the 2025 recipient of the Wharton Jacobs Levy Prize for Quantitative Financial Innovation. Sandy's 1976 Journal of Finance paper on the efficiency of competitive stock markets where trades have diverse information has greatly influenced how we understand, characterize, and model the nature and value of private information in markets, the mechanics and value of trading and trading systems, the role of noise, the distinction between and among passive and active approaches to investing, among a number of areas of influence.
The efficient market hypothesis holds that all available information is immediately incorporated into prices of a stock. But how does this happen? And what are the limits, if any, to the forces that govern this process? Thanks to the extraordinary work of Sandy Grossman, we have answers to these perplexing questions, as well as important insights into the role of information in security markets and implications for active management.
We are proud to award the 2025 Wharton Jacobs Levy Prize for Quantitative Financial Innovation to Sanford Sandy J. Grossman in recognition of his groundbreaking accomplishments. Thank you for your contributions and a hearty congratulations.
Folks, all good things come to an end. Thank you very much to Bruce Jacobs, Ken Levy, Sandy Grossman, and all of today's presenters, discussants, award recipients, our board members. Thank you for your service and your attendance. And thank you to everyone in the room, our wonderful expanded community and audience, for your engaging questions and thoughtful and interesting participation.